Great comment here. Where would I put Amazon on my risk and reward quadrant? I discussed Amazon also 2 years ago when I said to people that it was a great buy, and at the same conditions now, I would buy it for my diversified portfolio. Unfortunately, I didn't manage a diversified portfolio back then, but let's see where Amazon would go now from a 10-year risk and reward long-term perspective. This is the value investing quadrant I developed. We have reward on the x-axis and risk from high to low on the y-axis. This means a great buy, this means high risk, low reward, and as value investors we try to buy low risk, higher reward investments. Subscribe for that attitude. Let's go to Amazon to discuss the financial results. Very well presented there. Growth of 12% in revenues, net income growing hugely as their margins are expecting, that network effect is working great, 50 billion net income going forward. So cash flows also doing well. They are still hugely investing, 65 billion of investments going forward. That will likely lead to more growth. So we can also see how will Amazon grow in the future. And now, when it comes to investing, how you do depends on where you buy it. If you buy it here, then your returns will be great. But if you buy at a high valuation, then the risks are a little bit higher. And perhaps the key factor with Amazon is there is a factor dilution, and if they want to manage that dilution efficiently, then they need to spend, they issued, 80 million shares, they need to spend 18 billion to keep the share level flat. And if you calculate that, the P ratio of 50 billion on the market capitalization is a yield of earnings yield of 2%. If they need to spend 1% on dilution, current value creation from Amazon is 1%. Okay, you say, what about the growth? Well, the growth, given its size, is slowing down. Slowly and surely, it is still great at 8%, so nothing wrong with that. But if net income grows at 8% going forward, then in 10 years it will reach 107 billion. Okay, they should be able, because of economies of scale, to grow at 12%, 10% likely net income, but we are conservative value investors here, so we want to get the future growth for free. And you can only get that at a low price, so that's why I always am conservative. I watch these great companies, and when they fall into my bucket, in the next time I will buy Amazon for the diversified portfolio. And if I put a 20p ratio on a conservative 107 billion profits, that might happen in a year, in the next 10 years, that's a 2 trillion market capitalization, and that's lower than the current market cap. Keep in mind value investing conservativeness, and therefore I would put now Amazon at a low 10-year reward and high risk from a very conservative value investing perspective. But it is a great business, and next time it trades, you never know, recessions, this and that can happen over the next 10 years. I don't need to buy Amazon now, I just need one opportunity in a decade. And it usually happens with the companies that we follow. As I said, at the same risk and reward, so reward 2x that has already happened since the price here, risk 30%, then with a diversified portfolio you can buy first and they buy more, which was exactly the strategy discussed here. Next time I will buy Amazon, no question about it, because it's a great business, a network effect, the economies of scale, nothing wrong with it, just the price.